Hey, what's going on, everyone? So I wanted to make a quick follow-up video on EQR, Equity Residential. If you haven't seen my previous video that I published end of September, it pretty much laid out my entire thesis for why I thought the stock was cheap and why you should own it. Or at least the reason why I bought it. So I'll link it below if you haven't seen it. Go check it out. As the thumbnail suggests, I sold all my EQR shares and I sold it at 64. And I wasn't really looking to sell. It's just the market kind of threw a gift. And what I thought was going to take 2 years to realize the returns, it actually only took me 2 months. So I got out. But price target was not my main reason for getting out. It was actually more for fundamental reasons. I've been observing the leasing market in the 9 major markets that EQR kind of operates in. And with winter coming along and the fourth quarter being just a tough leasing season, and then COVID spiking pretty much everywhere, I just thought, the market kind of presented itself and perhaps it's time to pare back. So I'm going to show you 9 charts and sort of explain my process of what I was seeing and what I was comparing it to my thesis. And maybe then you can sort of make your own decisions on whether you want to buy, sell, or hold. So let's look at some of the charts. So the first chart that we're going to look at is Los Angeles. And let me explain this chart, and then all the other charts kind of look the same. So these are the year-over-year rent decrease percentages. And so the blue lines, the blue dotted line and the blue solid line are the rent decrease percentage reports from Zumper, their national rent report for each individual city. And so the solid line is their 1-bedroom prices, and the dashed line is their 2-bedroom prices. And then the black marks are the results that EQR realized on their new leases. So those were the results that they published in their financial reports. And then the red line, that is the rent decrease threshold that was baked in on my previous video. So my previous video, I thought, man, there was so much bad news that's already priced into the stock. Rents could fall all the way down to the red line and the stock would still kind of hold its value. And so what you're seeing in the LA market is that since Q2, rents for the 2-bedroom and 1-bedroom have actually fallen down towards that max threshold that I thought had already been baked into the stock. Now, what's really cool about being in real estate is that you can track these rent prices before EQR's earnings even come out. So when EQR's, I guess, Q3 earnings came out, which is the far right black line that you see, their new leases in the LA market was down 8% year over year. And you can see that since then, October and November, leases have fallen even further, and they're almost touching, that red line. So that is the premise behind kind of looking ahead of what EQR is going to report will give you a flavor of what's to come. And I haven't seen in the marketplace sort of a bottoming out process on this lease. And so that's what got me concerned, is that we're now in a tough leasing season, COVID is spiking, and, rents are falling, all the way down to the red line. So that is the premise behind kind of looking ahead of what EQR is going to report will give you a flavor of what's to come. And there's I haven't seen in the marketplace sort of a bottoming out process on this lease. And so that's what got me concerned, is that we're now in a tough leasing season, COVID is spiking, and these rent prices might actually pierce through what I thought was already baked in. So that's the LA market. Let's move on to the next market. Next market is Orange County. So Orange County is doing way better than LA, but Orange County is also, as a percentage of EQR's portfolio, a lot smaller. And so you'll see in this chart, my max rent decrease red line is at 10%. And EQR has generally reported a little bit better than what the Zumper reports are reporting. And so you can then extrapolate or assume that that tick up in November, EQR would then do slightly better than that. So that's good news in Orange County. Moving on to the San Diego chart, I had baked in a 10% rent decline max, and you'll see that EQR in general seemed to be tracking a little bit worse than the 1-bedroom, 2-bedroom average. And so San Diego market again is doing fairly well. It's really not down that much, and also it's a very small percentage of EQR's portfolio. So here's the San Francisco market, and you can see San Francisco is just, rents have just fallen through the floor. So what started at the beginning of the year as maybe a -3% has continued to decrease all the way to about -20%. And I think what's even more disturbing is that EQR has generally, it looks like they have generally underperformed Zumper's prices by another 5%. And so I have baked in a 28% rent decline, and you can see that Zumper is now reporting about -20, and if EQR is underperforming Zumper by another 5%, then you're pretty much at -25. And the reason why Zumper, or I guess the reason why EQR is always kind of underperforming Zumper is because EQR's, the percentages that they release has concessions already baked in, whereas the Zumper reports, I believe, do not have concessions. And so this is why you'll see EQR always being slightly underperforming these Zumper reports. And the San Francisco market is a pretty big percentage of EQR's portfolio. So that's not good news. Let's take a look at Washington, D.C. next. So Washington, D.C. doing fairly better than San Francisco. But nevertheless, what started as positive rent increases in the beginning of the year has now trended towards even my max loss that's sort of baked in. And also these black dashed lines, I had to make them lines so that they would show up. It's really just a dot at March, June, and September, because those are when they report those earnings. And so the 1-bedrooms are doing much worse than the 2-bedrooms, and the black lines, which shows kind of a mix between 1-bedrooms and 2-bedrooms, the results seem to kind of fall in between the Zumper rates. New York is headline news, seems like it's doing just as bad as San Francisco. But when you look at the data, it's not doing as bad, but then again, it hasn't hit bottom yet, so we don't really know where the bottom is at. But again, it's got the same profile where EQR seems to underperform Zumper by, quite a few percentage points. And so 1 bedroom, 2 bedroom year-over-year decreases in New York have hit -15. And then if you have to go down another, 8 percentage points to extrapolate what EQR is earning, you're kind of at that red line already. And then finally here, Seattle. Seattle started kind of weird. EQR was outperforming the general market report in the beginning of the year. And then towards the middle of the year, they were performing on par, and now they're subperforming. And I don't really know what the reason behind that is. But again, the trend is not going the right way. And from what I understand about the Seattle market, things have not gone easier. In fact, things have gone harder. And some of that reason is because the tech companies have postponed a lot of their hiring. But I would suggest that COVID and remote working has a lot to do with this too. Now, I'm not saying that these markets are dead. I'm just saying in the next quarter or two, it's going to be really tough. And I'm not certain where the bottom is. Moving on to the next chart, you see Boston. Fairly consistent in terms of EQR's performance relative to the Zumper reports. It looks like they underperform by about 10%. And so, in November, Boston touched about -13. So you can extrapolate that and assume maybe EQR's new leases in November are about -23, which is, again, pretty close to that red line. Moving on to Denver. Denver is such a weird chart. And it's weird because I don't see it in any of the other market reports. But check out the divergence between 1 bedroom and 2 bedrooms. I mean, 1 bedroom has fallen through the floor, and 2 bedrooms seem to be doing quite well. And so for EQR to kind of follow the solid blue line instead of the dash blue line makes me suspect that the new leases that they're capturing are mostly the 1 bedrooms. And in this Denver market, the EQR results have already hit the red line. And the Zumper reports going into October and November has dropped below the red line. There is some good news. Occupancy is currently at 95%. And so that's probably one of the major reasons why you're seeing these leasing concessions, is that they're paying for that occupancy in the hopes that it could get them through this tough leasing season in the winter. The other good news probably is the leases that they're capturing, half of them are renewals and the other half are new leases. And the rent rates or the rent decrease percentages on the renewals are actually not as bad. They're maybe down 5% on average. It's the new leases that they're capturing, that they're paying for to supplement the occupancy. These new leases are the ones that are truly bad. And those are the ones that kind of follow the rates that you saw on the charts. So this is what I was looking at. The data was kind of the reason, the driving force behind why I decided to let go of the stock. And I still believe in the company a lot, and I still believe in the long-term fundamentals of these cities and apartment buildings. It's just, there's way more uncertainty now than a couple of months ago, and all the bad news that I thought would supply a sort of cushion, a safety cushion, now has evaporated. And so we're now kind of at the bad news scenario that I thought won't occur, when in fact we're there now, and I still don't know what's ahead of us. And I hope that this provides valuable information to you. I don't know your entry point in the stock, so I can't tell you whether to buy, sell, or hold, but I'm hoping that this information can help you make your decisions. So with that, I want to thank you, and I hope you are staying safe, and I will see you next time.